Did we just witness retail traders peak fear and capitulation? A level we haven't reached in 10 years was just triggered according to JP Morgan. And as we know, it all happened at the most important zone that we've been discussing over the last few weeks, the daily 200 moving average. So what was Wall Street up to throughout the session? You may be surprised with the latest dark pool trades and of course holds across the board. With markets synergizing to incredible levels, today we need to discuss what just happened and what could be in store for all of us as traders and investors. Guys, this one's not to be missed. We'll see you in a moment. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, there is a lot to discuss because of course we hit the level that we've been talking about for so many weeks. The daily 200 moving average. What are the stats? What does the macro suggest? And of course, what happened to retail traders over the last 24 hours? Well, unfortunately for many, hopefully not you guys, it was a case of imbalance and capitulation. According to JP Morgan, in just the first hour of trade, $1.2 billion was liquidated from retail accounts as everybody rushed to sell all of their stocks during what was a fear-driven moment. Now, why is this important? Well, it hit a support line just as that occurred. And as you guys know, when you get these types of capitulation fears, you've got to put them in context. It turns out this was the worst one we've seen in a decade. And that basically means that people are incredibly fearful about this market right now, and potentially rightfully so. Tariffs, and of course, just in general, all sorts of other geopolitical tensions going on has people really worried about whether this market is completely overbought. But let's take a look at one of the key stats that we've been discussing, the daily 200 moving average. Now, we first brought up this stat up here near all-time highs, and we mentioned that there was almost 100%, well, there was a 100% chance based on data back from the 1990s that we would hit the daily 200 moving average this year and that we would hit it generally in Q1. Well, it's been achieved. Now comes the fact of what happens next. Do we see a bounce off this level as we traditionally have in the past, or are we going to see something else? Well, in today's video, we'll take a look at that, but let's just discuss the 200-day moving average in general. Last year, we were unable to hit this level, and as you guys know, that usually means that we're very strong. And of course, we ended up 2024 up 23.3% with an epic year. The last time we saw something like this was, as you guessed it, 2021. Now, why is it important to look at the next year? Well, even though we have now hit the 200-day moving average, we are not out of the problems yet. While it is acting as a very key support, and you'll see in just a moment the dark pool liquidity, that is Wall Street's liquidity, is coming in big time, we're not exactly at zones that I guess we can say absolutely the market is going to rip up. Because if you look at the year after missing the 200-day moving average, although we do hit it, it's very up, down, and all around. Only 50% of the time do we end up actually bullish by the end of the year. And this goes along with some of the things we've been saying on the channel all of the last 2 months. You really need to be thinking about 2025 as up, down, and all around. And you'll see that when we look at the structure in just a few moments. But let's take a look here at the volume trades that came through over the last 24 hours, because there are some massive ones. Just as retail was peak capitulation, somebody executed some massive trades. Have a look at this. FNGB, which is the microsectors FANG 3 times leveraged ETF, got its second, third, and largest trade all in one session near the lows. And this kind of marks a very important point because, of course, as retail investors were getting ripped up, somebody was coming in. We've seen this happen a few times actually over the last couple of days with big trades coming through. We also saw SVIX, which is of course short VIX futures, have a massive trade on it. Again, dark pool, which is pretty interesting here. And ProShares Ultra Qs got another huge trade on them as well, as you can see here with the 40th largest trade in the last couple of years. Now, why does all of this matter? Well, it happened at the support zone, and that 200-day moving average would tend to act as a bit of a key level. Now, it's not the first time we've seen these trades. We've actually seen them all over the last 1.5% of moves. If you have a look at the S&P 500 in our previous videos, and of course the NASDAQ itself, we've had some of these large trades come through near the closes of the day. And we suggested that maybe that was the beginning of an accumulation base from the street itself. Time will now tell whether we can regain some of the key levels. And if we do, of course, then you can give it a big tick and say that was a buy. We're probably going to all-time highs. But certainly there is a lot more activity around these lows as volatility absolutely ramps up across the board. Now, why is all this vol so important? Well, it's been up, down, and all around. And Subu Trade here did some very interesting stuff and work on it when it comes to negative 1.5, followed by a positive, followed by a negative. So that is basically whipsawing action that's coming through the markets. Well, as it turns out, you may think, well, that's going to be a huge sell across the board, volatility's up and everything's going to crash. But actually, it may not be. The stats are fairly positive when you take a look at 1 month later. And I think the important thing about this sell-off, which we'll look at soon, is the advanced decline line is barely down. What that's telling us is that in general, stocks and a lot of the back-end stocks, a lot of the rotation stocks are actually holding up or staying stable. And what this is telling us is it's a sell across high kind of valuation gamma stocks that have really been beaten up. Now, why could that be? A lot of you correctly pointed out over the last 24 hours in our videos that we hadn't discussed the GDP numbers yet. And this, I'm just going to read some stats to you just to give you an idea of how stupid and wild these numbers are and why in 2025, we're going to be after paying attention to what they're doing, not what they're saying. Remember, one of our big slogans here on the channel is if it's in the press, it's in the price. Take a look at the latest Atlanta Fed GDP estimates. 4 weeks ago, plus 3.9%. 2 weeks ago, plus 2.3%. Last week, negative 1.5%. And now, negative 2.8%. So on the bad case scenario here, it looks like the GDP is absolutely tanking. The problem is this is all, of course, a forecast. We don't know how it's going to play out. And ultimately, we don't know also whether we're going to get what we call a Fed put bought in. That is a accommodative central bank kind of decision, which may involve more cuts later on this year. I think the cut rate now is almost at a 50-50 for May, which was well lower than that only a few weeks ago. In terms of daily sentiment indexes, we just have not seen these indices go up like this before. And the last time we were so bearish was actually 2020 during the heights of the pandemic. Now, we're not seeing that actually throw through to real volatility, but people are super bearish. Puts are being stacked. And as you'll see later on today's video, there are puts everywhere around this 200-day moving average for both the Qs and the S&P. Now, there is a right reason why this could occur, and that is to do with semiconductors and, of course, what was a leader potentially becoming a lagger. And hopefully you guys can see this chart, but I shared this in our private community, and what it's showing is it's showing here that global semiconductor sales are kind of starting to decline a little bit compared to their previous highs and starting to fall off a little bit. Now, this is the lead sector. So if semiconductors start giving up the ghost, and obviously NVIDIA is barely holding on, we'll look at the options later on for that. That is such an important level for it, that if it gives up, that is a big warning sign that the rest of the market could capitulate and we could be going back into a 2022 or even worse style scenario. So it looks like there's a little bit of an issue there. We also shared in our previous video that the 7 of 8 bellwether topping signals have actually come through. Now, this doesn't mean, again, instant sell, but what it's telling us is that we are kind of making highs on markets and we're not doing it with what you'd usually see. Now, financials, that is looking excellent. Last 24 hours, though, they did sell. But cyclical sector indices, equal weighted, New York advanced decline levels, they weren't making new highs. They were unable to get through those November 29 highs, November kind of December periods for all of these. And that's telling us that maybe, there is a case to be saying we're topping out. Now, I don't believe that just yet because some of my leads aren't showing that, but I will say this. There's too much leverage in this market. This event that we've just seen over the last week and a half has most likely liquidated many, and unfortunately, that could be some people that are viewing right now. But in general, it doesn't have that broad-based capitulation sell that you would usually expect with a total fear market. We're also not seeing the bonds market absolutely freak out in the ways that you usually would during a proper financial crash. And that, I think, is a very important factor because we're still barely holding on to the price action. In terms of 5-day momentum, as we know, Goldman Sachs came out, and this is on the 2nd of March, so remember it's technically wrong here. But they were saying that there are so many puts and there's so much kind of pressure to the downside suddenly on the markets that it could instigate a short squeeze. Have we just seen the beginning of that over the last 24 hours, hitting that key level that we want? Well, as you know, Tom Lee, Fundstrat, all of these kind of guys, they're always looking for the positive. And I agree with two things. There could be a Trump put and a Fed put that could come in at any point with a click of a finger into these markets and could become accommodative. This is something we've seen for years and years and years and years and years. And obviously the question will then be, how long will these tariffs sit? Because of course, if tariffs are taken off, then that's going to be, a clear positive for the markets and they're going to like that. It could be also that we sit here though for months or weeks or even possibly more than that with the tariffs. The longer we sit with them, the more the signs are that the market is going to have a panic attack and try to instigate what we would call the Fed put, or in this case, the Trump put on that one. Obviously, the Fed coming out this week. We've got the State of the Union in less than 24 hours now to really kind of understand maybe what's going on. The market will be volatile over the next couple of sessions for sure. Let's now talk about S&P 500 post-election cycle. Funnily enough, we're actually following exactly the path that you would usually expect. You can see here Grant Hawkridge's chart showing the basing structure and showing the possibility of the market still being in very good shape later on this year. This is post-election cycle versus, what we usually are seeing. And it is following very closely. So for now, if we're going to see a bounce, this would be exactly the expectation that you would have around this daily 200 moving average. And it's something, of course, we were looking for. Now, if you've been watching the channel for a while, you know also that we're incredibly bullish on gold. We have been for over 2 years. And so far, it's been one of the best performing assets. It should continue to probably be that way. And the reason is geopolitical tensions and just also this timing and cyclical concepts of gold right now. Have a look here though, aggregated assets under management, gold continues to boom. And it is booming big time when you're looking at flows. And of course, this is important because it means there could be more left in the tank. And we've kind of said that there's a possibility here that we could go to 3,600 on gold, maybe even higher. Anything's possible. Our initial call was 3,000. We've hit 2,950. I still think that's a great TP for people looking for 3,000. But in general, there could be more left in the tank based on our cyclical studies and some of the things we talk about. If you're ever interested in more of these types of things, check out our courses, the advanced masterclass. You guys will be blown away with how replicable these super cycles are, along with business and of course other cycles underneath. I love cycles. I love data. You guys love it as well because you're watching. So check that out if you want to find out more about why I'm pretty sure this year and next year are going to be some of the most important to our lives. Let's now talk about 3-month flow. One of the things that I think is always interesting is when people capitulate. So we've just seen that potentially on semiconductors. Take a look here. This is a monster chart here from Scott Charts showing that semiconductor capitulation may have just happened in terms of the largest 3-month net outflow ever. And you might be saying, if it's outflowing like that, shouldn't you be actually going negative with it? Well, not really, not when you get capitulation. We've shown this with China. Obviously, we've been bullish when everyone has been bearish. This is the type of time where you can be a little bit contrarian, but NVIDIA will be the most important. We've also seen something else on home builders. Now, this one I'm a little bit more scared of because, of course, it's currently on support, but if it drops, that'll be key. Now, breaking down sectors, I guess, is the key to this year. And we've been talking defensive, low the leverage off, and obviously, really pay attention to the market sector rotation this year. Well, as it turns out, we've of course got healthcare as number one. At this stage, gold stock is above, but it's not a main sector. And the worst has been technology and consumer discretionary. Now, consumer discretionary being down this much shows us that the American consumer and sentiment is going down. And that's turning into a defensive style market. So with so much of the market made up of these two sectors, of course, it's very difficult for it to be ramping. And what this again is showing us is that even though we might grind higher for the year, we're going to most likely do it with different sectors than we have in the past 2 years. And that's just normal. That's what you usually expect to happen. When you're talking about weekly crypto asset flows, yeah, that's pretty negative. Very, very large outflow. Obviously, we've seen movements here that have been very positive. When you have outflows like this, of course, price action is going to have a hard time. But as we saw over the last 24 hours, BTC held the most important level into this week's most important information about the crypto reserve, etc. So we'll be paying attention to that. We also know, of course, with the last kind of couple of sessions, more outflows, both in Ethereum funds and Bitcoin funds on the 3rd of March. We'll keep tracking this to see when we get some significant inflows, but for now, it's just outflow, 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 outflow. All right, let's now jump into the sector rotation, and we'll have a look here at what was best last 24 hours. Funnily enough, technology actually ended up, semiconductors there, ending up 1% after opening horrifically. We saw Nvidia absolutely get smashed in the open, then rally straight back to the most traded zone. And as we've talked about, we'll be looking to find more information about that most traded zone holding up. KRE XLF down bad, maybe deregulation becoming a concern. And also, I would say the market is starting to worry about the idea of what's going to happen with the debt if we do see tariffs held for a long period of time. What about people? Are they going to be struggling? Well, it's very arguable that. And of course, there's a reason. Every time we sell off, there's always a good reason for it. The question is it enough to really tank the markets past certain points? A lot of people will be calling it. I always say it's very difficult to say a market is going to sell off when everybody is on top of that thing. Usually when the market starts to really get crippled, it will move with a broad-based sell-off and complete fear. This is different, and that is important to note. Let's now have a look at the last 5 days. Defensives holding up pretty well. The rest of the market, obviously not. And if we have a look at the S&P 500, we hit into a very, very important level, 5750 in particular. Now, you guys know why this is important. Let's have a look at this chart here. This is the 200-day moving average. And as you guys know, this is a super strong level. It's really all that's holding up in terms of demand and structure. So if you have a think about it, this is a very important previous trade zone. We rallied, we've found buying pressure here. We've wiped this. This will be the liquidation of many retail traders, although this should be the key level here. And we've come down to what we knew was a very high statistic. You've got 2050 crosses, which is a powerful kind of cross that a lot of people use, but as I would argue, often misguided. And the one thing that I guess I would say here is that we melted up very slowly. We obviously became dull. We've sold into this level and we closed as a long leg doji. Let's have a look at the futures market when we're taking a look at the S&P 500 and of course the NASDAQ itself. So if we have a look here, it comes down, it hits into that kind of 5,700 lows. This is exactly where you would expect usually the buyers to recommence if they're going to. We see dark pull, we see dark pull, we see dark pull. We've seen a lot of dark pulls around 58.50 as well. So really that last 100 points, all of a sudden, something's happening. Whatever it is, something's happening. If they're all big sells, well, we'll soon find out because the market will absolutely trash itself underneath these key levels. Next stop, yeah, you guessed it, 5,400. That would be pretty nasty. But this is all a standardized pullback to a normal year at this point. If we go from a high to a low of 7%, yeah, that's kind of how the S&P 500 rolls. 7 to 10%, pretty common in a lot of years. Daily 200 is the key. And speaking of daily 200s, look at this NASDAQ one. I mentioned this to our private community, but I'll tell it to you guys today. Obviously, we saw it in the pre-market. We were about here, and I said this is very likely, of course. And more importantly, take a look at these hits. 1 hit, rally, 2 hits, rally, 3 hits, 4 hits, and now the 5th hit. Now, it doesn't mean it's going to happen again. Of course, everything is stacking the odds together. But we have seen an oversell, and now we can start to talk about, what about these levels above here? What about above 21,000? Is that an incredibly good rally point? I would say it would be. As we always like to do, let's have a look at the S&P, and you'll instantly see this little market here. We rallied super hard, we hit 58.50, and we dumped. What if we get through this level? I think that's worthwhile setting an alert for now. This, to me, is signaling, yes, buyers are trying to squeeze higher. So these kind of levels, which remember are all of the largest trades, large trade, dark pull, dark pull, dark pull. So we've got them all here. This would be the kind of break level that I think would turn the market around. So we've already seen it test once, 58.60, 58.50. It's sold off. We may even make a new low. We could still hang around this daily 200, of course. But if we rally above this point, things are starting to look a lot better, of course. Now, why is this important? Well, if we have a look here, you can see the 570, 575. So basically, this means that the 5,700, 5,750 have puts all over them. There's puts everywhere. The puts are everywhere, guys, on these strikes. And if you take a look here, you'll notice that we get tons and tons of strikes at these zones. I'll just go back. There it is, 50, 57 kind of 80, 57, 70 now getting struck pretty heavily for the next couple of sessions, and really across the board. This is all expiration. So there's tons of stuff sitting at around these levels. This would be where the market should find support if you're looking at it from an options perspective. If you're looking at it here in terms of the 6th, this is the 6th of March expiration, you can see pretty clearly the 5750 is the most struck zone, and also 5800 becoming quite well struck. So what that's telling us is puts everywhere. Everyone's on puts, and the fear is kind of high. Retail capitulated potentially. And of course, if we're going to see bounces, you would usually expect the market to close above 5800. And then, of course, if we get through 5860, 5870, that kind of area there, that's going to be pretty key. When it comes to NVIDIA, you'll notice here that we are still sitting on those important levels. We close around 115. We already know 115, 110, 120. This is where all the puts are. So if the market's going to hold the semiconductor, the most important market sector in many ways, then we need to hold 115, 120. If we can, then of course we're finding buyers again, and things could change just like that. Let's speak about the bonds market now. Is the bonds market totally freaking out? It's going up. The freak out is definitely there a little bit, but it's not what we would call extreme fear like we've seen several times before. So we're watching it. We knew it was accelerating, and this is the level that we really were looking for. So at least we hit the daily 200 on the S&P, and that was key. US 10-year bounced after falling down. Again, all sorts of things. That could be a result of tariffing and stuff, but in general, of course, worthwhile paying attention to. And TLT therefore suffered, even though it was a day of sell-off. Generally speaking, if yields are going up, TLT could be going down. Still, we think TLT have found a base recently, though. US dollar getting tanked, coming back down to that key support, not breaking through it yet. We lose this it's kind of like 105.70, so it's exactly on the support. If it breaks below, next move 104s. So yeah, some significant stuff. Dollar really doing exactly what we'd think. And gold, of course, finding the bounce through 2850, moving to 2900 plus. That's good. This is all in a range bound now. I wouldn't mind for it to sit here for a while. And then if it does break up in the future, I'd say we smash 3000 and we go further up. Let's have a look at silver. Silver hits the resistance, 32, 32, 32. We break above that. Obviously, it's looking pretty strong. So let's take a look at some of the most important stocks. Obviously, Tesla in focus right now. Not looking very good when you're talking about sentiment and, of course, news coming out about it. I think one of the most important levels is something we've discussed recently, which is that 250. We got so close to it over the last 24 hours as more news came out with poor deliveries. Basically, between 250 and 220 or 220-ish is where you're seeing the biggest level of support. And Tesla may be disconnected from the market right now. So just remember, there are no significant buyers yet. 270, 280 is where the puts are. If you want to get involved in more of a bullish kind of move, at least make a structural high, which is going to be like a 301 plus. So we'll keep watching it and we'll keep looking. It's oversold on daily, but we haven't seen it, of course, rally through heavily yet. Let's have a look at NVIDIA and check this out. NVIDIA just held that 115, 116 most traded level. You guys know how important this is. So it's barely holding on. Obviously, the market's synergized with so many levels. Daily 200, most traded level. You guys know I love synergies. So when we see synergies across the board, it gives me more confidence that the market's doing what's meant to. Bitcoin also has done that with the 61.8 we'll look at soon. Semiconductors themselves fell to 220, which is getting close to that buying pressure support level. And as we know, this is an important sector. So far, looks pretty nasty. If you put it on a monthly chart, you'll get the idea of why it's kind of still semi-range bound. XLV, healthcare, one of the sectors we've liked recently. A little bit of a poor session for it as markets tried to buy the gamma stocks, buy the high kind of risk stocks or the growth areas. But you can see here, still holding down in that level. And HSI came back to the daily 20, which is, as we know, the most touched level of support, found the level of demand and bought up. So for now, of course, we're still buying China and we still think it has more to move. Pretty much a lot of people have asked, what do you think about this? It's more of a day trade level because, of course, if you were buying it as an investor, we've been focusing on it for the last year and it's been doing very, very nicely. It's now starting to get, picked up by a lot of people. US 2K hit support, found some buyers. Too early to tell whether those buyers will hold through. Again, similar to everything else, we tested the supplies. We weren't able to buy them. So if you're looking for a level of the next 24 hours, let's see at 2113. we get a close or we get a move above that, that could be signifying actual rallies on the smaller stocks. NASDAQ hit 20,000, almost perfect. That's exactly where I expected the second buy pressure to come in. So you can see here down this point. And again, daily 200 moving average. All of these signs quite good for the NASDAQ. I'd have to think there's a bounce somewhere around here in the next couple of days as we just keep seeing these dark pools stack up. Ethereum, still kind of crappy, fell to a new low, went under 2,000 for a moment there. You can see it's rallied up since that point, but still not much. Really, all eyes are on Bitcoin ahead of what may be occurring here with the crypto reserve kind of thing. But if you have a look, the big key level here was the 61.8. We held the golden pocket. We found that demand base, and then we found a buyer. And this was my thought process in the last video about where I thought this market would possibly find buyers. So far, so good. Let's get a new high. So for crypto traders, they're going to be looking at 89. It's really back to Bitcoin. Bitcoin has to be the one that leads out of this if it's going to. It always is. It's like the S&P 500 of crypto land. So that's going to be very important. You have a look at Solana as well. Let me check this out in terms of structure. This is an incredible level here down in these 140, 120 zones. So it's also looking pretty solid. And Ethereum is definitely, I would say, the weaker of the top 5 kind of coins at this stage. But, like anything, Bitcoin leads out. The rest will follow. And we'll see how that plays. That's going to be a storyline more than anything else. So far, so good for Bitcoin's hold. Let's now move over to the news. So we've got the State of the Union, which I believe is going to be pretty important in terms of we'll find out some more information. It's not here, but we've got it on that day. And then, of course, we can see here on Friday, we've got non-farms and Fed Chair Powell. So will we get some kind of reassurance from Fed Chair Powell, some kind of Fed put coming in, QE, something like that? These are the questions that, of course, Wall Street will be asking, and it's all happening at arguably one of the biggest turning points for markets, the daily 200 moving average. As we always like to do at the end of this show, we always like to talk about our thoughts on the markets, guys. In general, I would say first thing is you can't really be panicking too much in these markets. It is a defensive year. It is up, down, and all around. The daily 200 was a very likely hit. Of course, we know since the data of the 1990s. We've seen dark pool trades. We've obviously got puts everywhere. This usually marks a very key point. Oftentimes, you will find buying, even though it may not be the low of the low. I think it could be because we may see some better signs coming out of the next couple of announcements. But in general, there's a lot going on. If you're willing to or want to find out more about what we do, check us out on X. We do post a whole bunch of charts there that we also share here and even ones we don't. And of course, if you want to find out more about why we're pretty aware of 2025 already being nasty and potentially 26 being diabolical, then check out our courses, particularly the Advanced Masterclass. It'll blow your mind with the work that I've put in over the last 20 years getting this information together. It's just stuff you will not find anywhere else. Thanks so much, everybody. Subscribe, smash the alert. A lot coming at you over the next couple of days. And of course, we'll be there to bring you along with all the information that you need to know. Bye for now.